Gold has been quietly building one of the most powerful setups we've seen in decades, and most people have no idea what's about to happen. Right now, as I'm recording this, gold is trading near all-time highs. But here's what the mainstream financial media isn't telling you. This isn't the top. This is just the beginning of what could be the most explosive move in precious metals history. Let me show you exactly what I'm seeing in the charts, the data, and the institutional positioning that suggests gold is preparing for a vertical, parabolic move that could dwarf anything we witnessed in the past. The technical setup right now is absolutely remarkable. Gold has been consolidating in a tight range after breaking through multiple resistance levels that held for years. We're seeing a classic bull flag formation on the weekly charts, the kind of pattern that typically precedes massive breakouts. But it's not just the pattern itself that's significant. It's what's happening underneath the surface. Volume has been steadily increasing on every rally attempt, while declining on pullbacks. That's textbook accumulation. Someone is buying every dip, absorbing all available supply, and they're doing it quietly. The commitment of traders reports show commercial hedgers reducing their short positions to levels we haven't seen since right before the last major gold rally. These are the smart money players, the ones who actually move physical metal, and they're positioning for something big. Now let me take you back to a moment in history that might sound familiar. It's 1971 and President Nixon has just closed the gold window, effectively ending the Bretton Woods system. The dollar is no longer backed by gold. Most people at the time thought this was just a temporary measure, a minor policy adjustment. Gold was trading around $35 an ounce. Fast forward 9 years to 1980, and gold hit $850. That's a 2,400% increase. But here's what's fascinating. It didn't move in a straight line. It consolidated, built energy, frustrated traders who thought they'd missed the move, and then exploded higher in a parabolic surge that caught everyone off guard. The final move from 1978 to 1980 was absolutely vertical. Gold went from around $200 to $850 in less than 2 years. People who had been waiting for a pullback to buy never got their chance. The market just kept grinding higher, then suddenly went parabolic. We're seeing similar dynamics today, but the fundamental backdrop is actually far more bullish than it was in the 70s. Think about what's happening right now in the global monetary system. Central banks around the world are buying gold at the fastest pace in over 50 years. The World Gold Council reports that central banks purchased over 1,000 tons of gold last year alone. That's not just a number on a spreadsheet. That's real physical metal being removed from the market permanently. China's central bank has been buying gold every single month for over a year straight. They're not even trying to hide it anymore. Russia has been accumulating aggressively. India, Turkey, Poland, Singapore, the list goes on. These aren't small players making speculative bets. These are sovereign nations making strategic decisions about the future of their reserves. And here's the critical question. Why would central banks be buying gold at record highs if they thought the price was going to fall? These institutions have access to the best analysts, the most sophisticated models, and inside information we can only dream about. They're buying because they know something the average investor doesn't. Let me tell you about what happened at the London Bullion Market Association recently. There was a quiet panic among some of the major bullion banks. Physical delivery requests were spiking, and the available inventory to meet those requests was getting uncomfortably thin. The paper gold market, where most trading happens through futures and derivatives, is massive compared to the actual physical market. Estimates suggest there might be 100 ounces of paper gold claims for every 1 ounce of physical metal. This creates a dangerous situation. As long as everyone is happy trading paper contracts and settling in cash, the system works fine. But the moment a significant number of holders demand physical delivery, the whole structure becomes unstable. We saw glimpses of this stress during the pandemic when premiums on physical gold coins and bars exploded to levels never seen before. Right now, we're seeing those stress signals again. Premiums are rising. Delivery times are extending. Refineries are running at full capacity but still can't keep up with demand. This is the kind of market structure that precedes a short squeeze. Except in this case, it's not just traders getting squeezed. It's the entire fractional reserve system of the gold market. The COMEX, where most gold futures trading happens, has seen its registered inventory, the gold actually available for delivery, dropped to multi-year lows. Meanwhile, open interest, the number of contracts outstanding, remains elevated. This is a powder keg. If even a small percentage of those contract holders decide they want physical metal instead of cash settlement, we could see a scramble that sends prices vertical. Now let's talk about something most analysts completely miss: the supply side of the equation. Gold production has been essentially flat for years. The easy gold has already been mined. New discoveries are rare and increasingly expensive to develop. The average grade of gold ore being processed has been declining steadily. Miners are having to move more rock to extract the same amount of gold. Meanwhile, the cost of production has been rising. Energy costs, labor costs, equipment costs, regulatory costs, all trending higher. Many mining companies are barely profitable at current gold prices. There's no surge of new supply coming to meet this unprecedented demand. In fact, some analysts project that global gold production may have already peaked and could begin declining in the coming years. This supply-demand imbalance is fundamental and structural. It's not going away, and it's exactly the kind of setup that leads to parabolic price moves. Let me paint you a picture of what's happening in the real economy right now. Inflation has been running hot despite what official statistics claim. Anyone who buys groceries, pays rent, or fills up their gas tank knows the real inflation rate is far higher than the reported numbers. The purchasing power of the dollar has been eroding steadily. Now here's where it gets interesting for anyone thinking about retirement or long-term wealth preservation. Traditional portfolios of stocks and bonds have been getting hammered by this inflation. Real returns, after accounting for the loss of purchasing power, have been negative for many investors. People are watching their retirement accounts grow in nominal terms while their actual wealth shrinks. This is where gold has historically played a crucial role. It's not just an investment. It's insurance against monetary debasement. It's a store of value that's maintained its purchasing power across centuries and civilizations. When paper currencies fail, gold endures. And speaking of retirement accounts, here's something worth knowing. You can actually hold physical gold inside a retirement account through what's called a gold IRA. It's a way to get the tax advantages of a traditional IRA while holding real tangible assets instead of just paper promises. If you've got $100,000 or more in retirement savings, this might be worth exploring. I put together a free guide that explains exactly how it works, covers the rules, the process, the pros and cons. You'll find it in the description below. No obligation, just information that might be useful for your situation. All right, back to what's happening in the markets right now. The derivatives market for gold is absolutely massive, and it's creating some fascinating dynamics. Large banks and financial institutions have built enormous short positions in gold futures. They've been betting on gold going down, or at least not going up too fast. This worked well for years when gold was range-bound, but now that gold is breaking out to new highs, these short positions are underwater and getting more painful by the day. Here's what happens in a short squeeze. Traders who are short have to buy to close their positions. But their buying pushes the price higher, which forces more shorts to cover, which pushes the price even higher. It becomes a self-reinforcing cycle. We've seen this happen in individual stocks. We saw it with GameStop and AMC. But imagine that dynamic playing out in a market as large and important as gold. The potential for a squeeze in gold is actually far greater than in those meme stocks because the fundamental demand is real and sustained. This isn't retail traders coordinating on social media. This is central banks, sovereign wealth funds, pension funds, and institutional investors making strategic allocation decisions. Let me tell you about what happened in 2011. Gold had been in a bull market for a decade, steadily climbing from around $250 to over $1,900. Most of that move was orderly, predictable, following a clear uptrend. But in the final months of that rally, something changed. The pace accelerated. Gold went from $1,500 to $1,900 in just a few months. That final surge was parabolic. What triggered it? A combination of factors. The European debt crisis was escalating. The U.S. had just lost its AAA credit rating for the first time in history. Central banks were launching massive quantitative easing programs. Fear was high, and investors were scrambling for safety. Today, we have similar conditions, but arguably more extreme. Government debt levels are far higher now than they were in 2011. The Federal Reserve's balance sheet has exploded. We've seen unprecedented monetary expansion, and now we're dealing with geopolitical tensions that make 2011 look calm by comparison. The situation in Ukraine, tensions between the US and China, instability in the Middle East, the fracturing of the global trading system, all of this creates uncertainty, and uncertainty drives demand for gold. But here's what's different this time, and why the move could be even more dramatic. In 2011, gold was still viewed by many institutional investors as a fringe asset, something for gold bugs and conspiracy theorists. Today, gold is increasingly seen as a legitimate portfolio allocation by mainstream institutions. Major pension funds, endowments, and sovereign wealth funds are adding gold to their holdings. This institutional adoption is crucial because these players move massive amounts of capital. When a pension fund decides to allocate even 1 or 2% of their portfolio to gold, that's billions of dollars of buying pressure. And once that trend starts, it tends to accelerate as other institutions follow suit. The technical indicators are all flashing the same signal right now. The relative strength index shows gold is strong but not yet overbought. The moving average convergence divergence is showing bullish momentum building. We're seeing golden crosses on multiple time frames, where shorter-term moving averages cross above longer-term ones. These are the kinds of signals that precede major moves, but technical analysis only tells part of the story. The real power comes from understanding the fundamental forces at work. Let's talk about the dollar for a moment. The US dollar has been the world's reserve currency since World War II. This gives the United States enormous advantages. We can print money to pay our debts. We can impose sanctions that cut countries off from the global financial system. We can run massive trade deficits because the world needs dollars. But that dominance is being challenged like never before. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems. They're accumulating gold as a neutral reserve asset that no single country controls. Saudi Arabia, long a cornerstone of the petrodollar system, is now accepting payment for oil in currencies other than dollars. This is a seismic shift that's not getting nearly enough attention. The petrodollar system has been a key pillar supporting dollar dominance for 50 years. If that unravels, the implications for the dollar and for gold are enormous. Here's a scenario that keeps financial analysts up at night. What if a major economy, let's say China, decided to back their currency with gold? Not a full gold standard like we had in the past, but even a partial backing, where they guarantee that their currency can be exchanged for a certain amount of gold. This would instantly make their currency more attractive for international trade and reserves. It would put enormous pressure on other currencies, including the dollar. And it would send gold prices absolutely vertical as countries scrambled to acquire enough gold to back their own currencies. Is this likely to happen tomorrow? Probably not. But is it possible? Absolutely. And the fact that it's even being discussed in serious policy circles tells you how much the monetary landscape is shifting. The mining sector is sending signals too. Major gold mining companies have been underperforming gold itself for years. Their stock prices haven't kept pace with the rise in gold prices. This is unusual. Typically, mining stocks are leverage plays on gold. When gold goes up 10%, mining stocks might go up 20 or 30% because their profit margins expand dramatically. The fact that mining stocks have been lagging suggests that investors don't yet believe this gold rally is sustainable. They're skeptical. They're waiting for confirmation. But here's what happens when that skepticism finally breaks. When investors realize the gold rally is real and sustainable, money floods into mining stocks. We saw this in the early 2000s. We saw it again in 2016, and we're likely to see it again soon. The setup in mining stocks right now is actually more compelling than in gold itself. Many quality mining companies are trading at valuations that make no sense if gold continues higher. They're priced as if gold is going back to $1,500. But if gold goes to $3,000, $4,000 or higher, these companies will generate absolutely massive cash flows. Smart investors are starting to position in mining stocks now, before the crowd catches on. They're buying quality companies with low production costs, long mine lives, and strong balance sheets. These are the companies that will be the biggest winners in a gold bull market. Let me tell you about the psychology of parabolic moves because understanding this is crucial. In the early stages of a bull market, prices rise slowly and steadily. Most people ignore it. Then prices start accelerating. Some early adopters jump in. The move continues. More people notice. Media coverage increases. FOMO, fear of missing out, starts to build. This is when things get interesting. People who were skeptical start to reconsider. They see gold hitting new highs week after week. They see their friends and colleagues making money. They start to feel like they're being left behind. This psychological shift creates a feedback loop. More buyers enter the market, pushing prices higher, which attracts even more buyers. In the final stage of a parabolic move, rationality goes out the window. People buy simply because prices are going up. They don't care about fundamentals or valuations. They just don't want to miss out. This is when you see the most dramatic price increases. Gold could go up $100 in a day, then $200, then $500. We saw this exact pattern in Bitcoin in 2017 and again in 2021. We've seen it in tech stocks during bubbles, we've seen it in real estate, and we've definitely seen it in gold during previous bull markets. The key is recognizing where we are in this cycle. Right now, we're still in the early stages. Most mainstream investors aren't paying attention to gold. It's not making headlines every day. Your neighbors aren't talking about it at barbecues. This is actually the best time to position yourself before the parabolic phase begins. There's a concept in market analysis called the wall of worry. Bull markets climb a wall of worry. There are always reasons to be skeptical, always reasons to wait. The economy might slow down. The Fed might raise rates. Stocks might crash and drag gold down with them. There's always something to worry about. But here's the thing. By the time all those worries are resolved and everything looks perfect, the big move has already happened. The best returns come from buying when there's still uncertainty, when you have to have conviction in your analysis despite the doubts. Right now, there's plenty of worry. People are worried about recession. They're worried about inflation. They're worried about geopolitics. They're worried about the banking system. And all of those worries are actually bullish for gold. Gold thrives on uncertainty and fear. The commercial banks that trade gold futures are in an interesting position right now. They've traditionally been net short gold, betting against price increases. This makes sense for them because they're often hedging physical gold holdings or providing liquidity to the market. But their short positions have been shrinking dramatically. They're covering shorts and in some cases even going net long. This is a major shift. When the smart money that's usually betting against gold starts betting with it, you need to pay attention. These traders have access to order flow data, client positioning, and market intelligence that retail investors can only dream about. If they're flipping bullish, there's probably a good reason. The exchange-traded funds that hold physical gold have been seeing steady inflows. Billions of dollars are flowing into gold ETFs as investors seek exposure to the metal. This is important because ETF buying translates directly into physical gold demand. When you buy shares of a gold ETF, the fund has to buy actual gold to back those shares. This removes gold from the market and puts upward pressure on prices. Some of the largest gold ETFs are reporting their highest holdings in years. The SPDR Gold Trust, the largest gold ETF in the world, has seen consistent inflows. The iShares Gold Trust is seeing similar demand. This institutional and retail buying through ETFs is a powerful force supporting gold prices. Now let's talk about what could trigger the parabolic move. There are several potential catalysts on the horizon. A major geopolitical event could do it. A crisis in the banking system could do it. A sharp acceleration in inflation could do it. A loss of confidence in the dollar could do it. Or it could simply be the technical breakout itself that triggers momentum buying and a short squeeze. The beauty of a parabolic setup is that you don't necessarily need a specific catalyst. Sometimes the market just reaches a tipping point where the accumulated buying pressure overwhelms the sellers and prices explode higher. We've seen this happen countless times in various markets. What we're looking for is a decisive break above key resistance levels with strong volume. If gold can break through and hold above its previous all-time highs with conviction, That could be the signal that the parabolic phase has begun. Once that happens, the move could be swift and dramatic. History shows us that parabolic moves in gold tend to last anywhere from several months to a couple of years. The 1979 to 1980 move lasted about 18 months. The 2009-2011 move lasted about 2.5 years. If we're entering a similar phase now, we could be looking at a multi-year bull market that takes gold to levels most people think are impossible. Some analysts are projecting gold could reach $3,000. Others are calling for $5,000. The more aggressive forecasts go even higher, to $10,000 or beyond. Are these numbers realistic? Well, if you adjust the 1980 peak of $850 for inflation, gold would need to reach over $3,000 just to match that high in real terms. So $3,000 isn't some wild fantasy. It's actually quite conservative from a historical perspective. But here's what most people miss. In a true parabolic move, prices don't stop at logical targets. They overshoot. They go higher than anyone expects because the buying becomes irrational and momentum-driven. If gold enters a genuine parabolic phase, it could easily exceed even the most bullish projections. The key for investors is positioning before the move happens. Once gold is making new highs every day and dominating financial news, it's too late to get the best returns. The big money is made by those who recognize the setup early and have the patience and conviction to hold through the volatility. And make no mistake, there will be volatility. Parabolic moves don't go straight up. There are sharp pullbacks that shake out weak hands. There are days where gold drops $50 or $100 and everyone panics. But those pullbacks are buying opportunities for those who understand the bigger picture. The smart approach is to build a position gradually, buying on dips and weakness rather than chasing strength. Dollar-cost averaging into gold over time can be an effective strategy. And for those with larger portfolios, allocating a meaningful percentage to gold and gold-related assets makes sense from a risk management perspective. One of the most compelling aspects of this setup is the asymmetric risk-reward profile. The downside risk in gold at current levels is relatively limited. Even if gold pulls back, there's strong support from central bank buying, physical demand, and the fundamental supply-demand imbalance. But the upside potential is enormous. If gold does enter a parabolic phase, the gains could be life-changing. This is the kind of opportunity that doesn't come around often. We're talking about a potential once-in-a-decade or once-in-a-generation move in one of the world's most important assets. The setup is there, the fundamentals are there, the technical picture is there, the institutional positioning is there. All the pieces are in place. The question isn't whether gold will move higher. The question is how high and how fast. And based on everything we're seeing, the answer could be much higher and much faster than most people expect. This isn't just another leg up in a bull market. This could be the beginning of a vertical parabolic move that rewrites the record books and creates enormous wealth for those positioned correctly. The time to pay attention is now, while gold is still building energy, while most investors are still skeptical, while the mainstream media is still focused on other things. Because once this move begins in earnest, once the parabola starts, there won't be time to carefully analyze and position. The market will move too fast. Prices will gap higher, and those who waited for confirmation will be buying at much higher levels. Gold is preparing for something special. The charts show it. The fundamentals support it. The institutional positioning confirms it. And history tells us that when all these factors align, extraordinary moves can happen. The vertical move everyone's been waiting for might be closer than anyone realizes.